In today's video, we're going to talk about three investment strategies that I use, that you can potentially use, the pros and cons of each, and why they might be a good choice for you. So overall, we're going to talk about dividend growth investment, my bread and butter, what people really like to see in my channel. We're going to talk about two alternative strategies. However, we're also going to talk about growth investment, really focused on growing companies and why that might be a good strategy for you. And then lastly, we'll talk about value investing. So, more fun type, risky type adventures, right, in investing, and why you may or may not want to do that strategy as well. So hopefully you guys will hit the subscribe button, hit the like button, tell your friends about the video, and let's get started with today's episode. In our first section today, we're going to talk about dividend growth investing. So for those of you who already follow the channel or have seen my previous videos, that is the majority of focus in my channel. We talk about dividends, dividend growth, and how to achieve passive income. I wanted to dive a little bit deeper in what dividend growth investing means, why I choose to focus on that in the channel, and some pros and cons. So I'm going to give you two pros and cons for each investing strategy that we talk through today. First of all, let's talk through dividend growth. So you can see my portfolio, it's labeled passive income, right? And that is pro number one, is passive income. So I think with dividend growth, you're really looking for a way to set up an account and get the rewards of choosing very good companies, right? So you are looking at, how can I invest in a company's future that I think will last for a long time? And they're focused on paying out dividends to their investors. And more importantly, they grow their dividends year over year, right? So I think of this as like a retirement fund for me, right? So I think a lot of what I'm focused on is picking the right companies who are going to grow their dividends. So that way I do not have to worry about inflation, for example, right? Hopefully they are growing at a percent that is above inflation overall, and they're giving me a big enough return to provide me a steady set of income over the years. So that's why this portfolio is labeled passive income. So that's pro number one. You can see from my current results. So this is from when I started to today. We have a gain of around $290, right, on my account. And the interesting part of this is that the market gain is actually negative, right? So it was positive if you check a few episodes ago, but it's come down a little bit this week. And what's actually keeping me in the overall green with a 3% positive return are my earned dividends over this time. You can see I've earned around $310 worth of dividends. And so that offsets the losses in the market from the companies that I have included in this portfolio. So let's just check really quick. You can see the activity and what I mean by dividend activity. So you can see each one of these dividends as they get paid out. Most of them are quarterly. Some of them, like Realty Income, happen every month. But overall, you can see what is occurring. So I own, several shares of Prudential, and they just paid me a $10 dividend, right? Realty Income, 71-cent dividend. ORI, $4.58. And so all of these dividends eventually add up to a decent amount of cash, right? And with compounding and what we call DRIP, so dividend reinvestment, we are putting those dividends back into the same companies that are providing the dividends. So it only compounds the growth of my dividends, which makes it really a very long-term strategy. So pro number one is easy passive income. I think pro number two is in order to pick companies that have solid dividend growth, you're picking solid, stable companies, right? These are companies that you can hold for decades and probably not worry about their financial stability. So if we go into my holdings tab here, you will see the types of companies that I own. So, and this is sorted by value. So the highest dollar amount that I have, you see Philip Morris, Altria Group, Coca-Cola, Johnson & Johnson, Microsoft, AbbVie. These are all fairly big, stable companies, right? And these companies are able to not only sustain their business, but they're able to perform so well that they pay out a dividend and they grow it almost every year, right? So I think that is the gist of why this is a solid strategy for me and why I focus on it on the channel. To me, it's the most interesting. You're looking at how can these companies do so well that they're paying their investors a dividend. They have so much cash that they're able to grow their dividend every year, and you really don't have to worry about a lot of these companies, right? If you pick the right companies, you can just set this portfolio. There's a lot of upfront work. You have to pick the right companies. You have to understand their businesses. But after that, you can kind of set it and forget it. And that's one thing I really like about this strategy is that there's not a lot of micromanaging, a lot of details that you have to look at every day. You really just have to make sure they're staying on track with their dividend growth, and you can really profit quite a bit from that long term. So I think the cons, I'll give you two cons as well for every one of the strategies that we're talking about today, is slower growth, right? So these dividend companies, while they grow their dividend, they may not be growing their share price at a high, rapid rate, right? These companies tend to be very stable. They tend to grow at a sustainable rate. They are paying out dividends, but they aren't explosive growth companies, right? These aren't, usually there aren't a lot of technology companies, although you can see here I own Microsoft, which is a technology company. But usually there is slower growth with dividends, right? So you may not see the overall market gains, but you do, like, again, let's jump back to my portfolio. You may not see the market gains that you would with other growth companies, right? But you do see the earned dividends. So if you're the type who is obsessed with, prices, share prices, and seeing that high market gain and kind of trying to exploit like the high growth of certain companies, I wouldn't say that dividend growth is going to get you get you those results. But you should consider kind of the offset. So when we are in downtimes and the market might not be gaining or it's losing, think about those dividends and how they offset that gain. So that's con number one, is slower growth or market gains. And then I think the other con is that this is a very long-term strategy, right? So if you're looking to get rich quick, dividend growth is probably not for you, right? It actually is faster than most people think because of compounding, and people don't really have a good grasp of compounding and how quickly you can accumulate wealth. But this really is a long-term strategy, right? So this passive income, the reason I think it makes good YouTube content, for example, is that we can track it over time and see how I'm doing over time and always have kind of constant updates, because this is a long-term strategy for me. This is not something that is going to kind of get me super rich, super quick, and I'm going to make a ton of money off of one explosive stock. It's about being smart with your investments and hopefully having a portfolio that can last you a long time and is a lower risk overall. And that's why it tends to be a longer term strategy. So again, I think for some people that's a con. For me, that's not necessarily a con, but for some people it might be. For our next section, we're going to talk about growth investing. And surprise, surprise, everybody, my only investing strategy is not dividend growth investing. I actually use other methods of investing, and I want to talk you through what I do with my growth investments. Typically, they're sitting in ETFs or some kind of funds so that I don't have to manage them. So we're going to walk you through a 401k plan that I have here. And another surprise, I don't only use M1 Finance, right? So we looked at M1 Finance when we talked about dividend growth investing. I think that's a great platform for dividend growth because of the reinvestment options that it has and just the utility that it has. But for my growth investing, I typically am putting these into funds that are growth-oriented funds, and then I am letting them sit there. So I think Fidelity has a great service for a lot of 401k and retirement plans. And so we're going to walk you through a 401k that I have. So you can see the balance right now is 63,000. The rate of return, so 1 year rate of return is 35%. And year-to-date return is 19%. So pretty good overall, right? That's a pretty good rate of return. And I think what I can show you through this is the contributions. And again, we're going to walk through two pros and two cons. So the first pro is really faster market gain. So you guys can see this, right, in the rate of return here. We can investment, performance, and research. If we go here, you can see the chart. So let's look at so this is broken up into two portions, right? I have this growth pool, and then I have this retirement by year fund, which I don't have a ton in there, right? That only makes up about 9.5% of it. So let's go into the growth pool. And if we look at the chart and we compare it, you can see since my initial purchase date, you can kind of see how growth has happened, right? And that looks pretty good overall, right? We're up on a cost basis. We're up around, it looks like, I don't know, around 20,000 almost, right? And we can look at annualized rates of return. So here's my overall 1 year return for this growth pool, 40%, right? That's really good market growth. If we look at the Russell 3000 growth, you can see I'm outpacing it quite a bit. And that's other growth indexes, right? So I think overall it's doing pretty well. Again, since my initial purchase, overall I've had an 18% growth rate. I think this is a pretty good tool to see how things compare. You can also compare this against other funds or other indexes to see how you compare against the S&P 500. But overall, growth investing allows you to invest in certain companies that are growth oriented and will get you that share price that we were talking about previously, right? It gets you, you can understand that they will grow in the future. They have very good prospects for their products. And let's go into what some of these actually are. So if we look at this Fidelity Growth Company commingled pool class 3, not the sexiest name on the planet, but you can see the top 10 holdings, right? So Nvidia Corp, they make graphics cards, basically. Amazon, Apple, Microsoft, Alphabet, which is Google, Lululemon, Shopify, which is a shopping platform, e-commerce platform, Salesforce, which is a software as a service company, Facebook, and then more Google Class C shares here. So overall, you'll tend to notice a lot of technology companies, right? Technology is a growing industry. And so I think that's the key to growth investment is investing in funds or stocks, individual stocks that are poised for growth. I think the other pro, right, is big numbers. People like to see big numbers. They like to see kind of this rapid growth. Again, let's go back to my summary here. And you can see just this rate of return is awful high, right? And people like to see that number, and that gets them enthusiastic about investing. And hopefully if they're investing in the right companies, that just encourages them to keep investing, right? So it's a feel-good story. I think the flip side of that is when this goes negative, it can go really negative, right? So if you're in growth companies and you're picking the right ones, I think it's a viable strategy. I think, for me personally, I tend to invest in growth funds rather than individual stocks because I think it's hard and you limit your diversification and you have a higher risk of one of those going particularly wrong. Whereas with some of these blended funds, you can actually get exposure to a lot of different companies and benefit from different sectors as well. So I think, again, the pros, just to recap, are the faster market gains and then seeing the big numbers, right? Psychologically, I think people enjoy that. Some of the cons. So some of the cons with this is just dividend reinvestment. So that would be or dividend income. I think you sacrifice quite a bit of dividend income. So let's see if we can see it here in the transaction history. We can look through what happened in the last 90 days and let's see if I got any dividends here. No transactions. Let's see, year to date. No transactions there. So I don't actually think I can see them. But overall, I think you risk or you lose the ability to control your dividends. So it's not really a great source of passive income. It's more of a let's bet on a company and hope that they continue to grow and they are successful in the future. The second con, I think, is that it's very industry dependent, right? So like I mentioned, a lot of those top 10 holdings are in tech companies. So tech companies tend to be the growing industry right now. Obviously, if some other industry became a hot growing industry, that's where these funds would shift. But that means you have less diversification overall. You have less exposure to other industries. And so if that whole industry tanks at one time, then you run the risk of seeing really negative returns. And so again, this can flip kind of overnight, like we saw with the tech bubble of the like early 2000s. So, you can see a big dip if an entire industry, and that's the one that was growing, all of a sudden stops growing, and that there's a bubble in that industry. So I think you just have to be careful. Again, I have money in both strategies. I don't tend to focus on the growth strategy as much in this channel, but it is a viable investment strategy. So for our third strategy, we are focused on value investing. And surprise, surprise, I'm using a different platform to represent some of my portfolio, and that is Robinhood. I really like what they do with individual stocks, how they visualize them, how you're able to trade individual stocks. I think it's a really good platform. And I will put a link down below in how to see my portfolio and how you can get started investing in Robinhood. So overall, with value investing, what you're looking for are companies that you believe are priced low at the time and are poised to grow very rapidly, right? So it's a little bit of speculation and trying to time the market, and we'll get into that in the cons section of this. But overall, you're looking for things that are valued really well, hence the name of value investing. So you can see the stocks that I currently own here, how many shares. So I have Store, Realty Income, Starbucks, Public Storage, and Prudential. I have a few others on my watch list. Like this is just the S&P 500. So I always want to see how this compares to the shares that I own. I also have Altria, even though that's in my dividend growth portfolio, and Coca-Cola, same thing. So one thing you'll notice here is that all of these stocks here are actually in my dividend growth portfolio. So even though they are dividend growers, I also thought that at certain times they were valued unfairly or valued at a low price when they should have been higher and were poised to grow. And you can see that, when the coronavirus hit and the market started to drop dramatically, I started buying. And so overall, since, let's call this the coronavirus time frame, let's look at the 3-month time frame here, I'm up 38%, right? So pretty good choices I made here with some of these companies. I think you really have to be well versed in what they're doing, their business models, some of their financial modeling, their stock prices, and really understanding the financials in order to do this effectively. I don't think you can take wild guesses. I mean, you can always take wild guesses, right? But I wouldn't recommend it. And so I think, there's kind of two approaches: picking companies that you think are poised for growth and really doing the research, and then just picking really cheap companies that you think are potentially a risky bet, but could turn out in the future, right? And I've done that in the past. So like if we go to the all view here, you can see I owned a company back here, and I had about $2,400 worth. And it started dropping rapidly. I was down to 1,500, but I believed in the company enough to hold on to it. And you can see it came back up to 3250, around 34% growth, and I sold it at that point, right? And I didn't really do a lot of investing in between. I wasn't focused on this. I started focusing on dividend growth, saving money for other reasons, and then we had a coronavirus panic, and I thought this might be a good time to invest in some undervalued companies. So this was more speculative back here with this company. It was a pharmaceutical company. They had a very good set of research, and they were doing their trials, and the trials looked good, and they potentially had a blockbuster drug. Turns out that I actually do, and I actually do own some more of those shares in a different account that's in a Charles Schwab account. But overall, that was more speculative trading, hoping that company would turn around and produce a blockbuster drug. My background is actually in science, and so I can actually read the research results and understand what's going on with those things. And I think it's a space where you can actually make quite a bit of money is in pharmaceuticals if you understand research and they are publicly traded companies. But overall, let's get to the pros and cons. So first of all, the pro here is you can hit it big, right? You can pick that one stellar company that you think is undervalued. Let's jump back to this view. That you think is undervalued, and it can really take off. The key with that is, again, doing your research. You really need to understand the company. So why I invested so heavily in Store, right? You see about 139 shares. Let's see if it will tell me my cost here. So you can see, the cost was $23.94. My average cost was $17 per share, and we're up to $24. I know quite a bit about Store Capital. I think it's a really good company, and I think they're one of the better positioned REITs to withstand the coronavirus panic. And I just thought they were highly undervalued, right? And you can see that that's paid off so far. So I'm up almost 40% on this one stock, and that's why I invested so heavily in the shares that I did. So overall, I think that is what you need to do. You have to do your research. You really need to understand what is the value that is missing from the company, and you think the market will eventually recognize that. So you can hit it big quickly, right? Big payoff. I think the other pro here is you can use less upfront capital. So you can take more risks, right, on some of these companies. There's this whole like penny stock theory, right, where you can buy really cheap stocks, and you won't necessarily lose a lot of money if those companies go out of business, but you could earn a ton of money if they do really well and turn around, right? So it's kind of the upside versus downside. So having really low downside because you're not going to be out of a ton of money versus really huge upsides, that's where a lot of people think about how people think about value investing. So on to the cons. I think this is super timing dependent. And as you guys know from a lot of my other videos, I never try to really time the market. So you can see if you go back to this all view, I really didn't do individual stock trading at all in like a 2-year time period because I didn't think that, I could accurately predict when things were going up and down. Now, if I focused more on it, I probably could do some trades here and there and make some money, but I really don't like any activity where you have to time the market because nobody can guess the market, right? That's what a lot of famous big time investors have told us, Peter Lynch, Warren Buffett, right? You really have to depend on the company's fundamentals. And I think dividend growth is a better way to do that and a better way to invest overall. So I wouldn't recommend trying to ever time the market. You can really, you can time it poorly and then you end up losing quite a bit of money. You can either time it where it's a minor blip and the company doesn't grow as much as you expect it to grow, right? They're really just kind of stagnating and you thought it was a big dip, but it's really, they just hit like a lower plateau and they're going to stay there for a while. Or you can hit what is my other con, which is called a falling knife, right? So these are companies that you think, oh, wow, there's a huge dip in their price. It's time to invest. But it could just be on its way to bankruptcy, right? Or the company could be have fundamental problems with their financials and with their operations, and they really deserve that lower price in the market. And you are just, contributing to that stock when it's on its way down and could go even further down, right? And that's not in a position you want to be in. So you really have to watch out for what they call falling knives. And that's really one of the biggest cons with value investing. So that both of those things make it inherently risky. You can see I don't have a ton of money invested in this value investing strategy. But overall, I think to recap, there's kind of 3 investing strategies that I covered today. There are others out there as well. I think in all of these, do your research, right? Like what kind of person are you? What kind of investor are you? What strategy makes you feel good? What strategy will set you up for financial success in the future? And also just keep the pros and cons in mind, right? Like I have these 3 different strategies and I mix them. I'm more focused on dividend growth investment right now, but maybe, in the future that might change. It really depends on kind of your circumstances in life, where you are in your investing journey. Hopefully you guys got a ton out of this video. I really enjoyed shooting this video because it shows you other facets of my portfolio. So if you enjoyed it, feel free to give me a thumbs up. Hit the subscribe button, tell your friends, leave a comment on your favorite investment strategy below, and I'll see you guys again next week.